Meet Amala. She just set up a new savings account at a bank near campus. It's an important part of her spending plan so she can be in control of her money and have what she wants and needs without a lot of debt. So what exactly is saving? Saving is simply setting aside money now in preparation for the future. It is another tool that will help Amala know where her money goes, instead of just hoping she will have enough later on to pay for what she needs. One important savings rule to keep in mind is pay yourself first. And what does that mean? Pay yourself first means putting a set amount of your money into a savings account before using the rest for your expenses. This is the magic sauce for successfully saving your money. A cool tip for making it happen? Include saving as an expense item in your spending plan. Amala learned that following this rule will allow her to establish an emergency fund so she won't have to rely on credit cards or student loans, successfully reach her financial goals, and be able to purchase what she wants without debt. Another great tip she learned is to try to save at least 3 months' worth of her normal expenses in an emergency fund to cover basic necessities. That seems like a lot, but she will start out saving a little each month and build toward that amount. You never know when you might need it, and even a little bit helps. Before Amala opened a savings account, she had to decide where she wanted to keep her money. She knew there were 4 common types of financial institutions that offer savings options. She could have an account with a big bank, a local community bank, an online bank, or a credit union. Each type of bank has different features that appeal to different people. Big banks tend to have more locations and ATMs, while credit unions and online banks tend to have lower fees. And each bank has different fees associated with things like account maintenance, ATM usage, and account overdrafts. Amala considered the features she wanted in a financial institution and the associated fees to find the right financial institution for her. While checking out her options, she discovered that banks and credit unions both provide 4 basic types of accounts she could use for savings: regular checking accounts, good old savings accounts, money market accounts, and something called a certificate of deposit, or CD. She was told that both checking and savings accounts are good for keeping the money she would use all the time. A savings account is a good place to keep her emergency fund, since it's easily accessible if she needs it. For larger sums of money, or money she wouldn't need for at least 6 months or longer, she was told she could consider a money market account, or a CD. That sounded like a great option for when she had built up her savings over time, but for now, Amala chose to open a savings account that is linked to a checking account in the same bank. Amala has also heard a lot about investing and wondered if that would be a good option for her to earn interest on what she saves. What she learned is that, for the most part, saving is really good for her short-term goals, like something she'll need to pay for in 5 years or less, such as a down payment on a car or house. Investing is good for any of her long-term goals, the things she'll need more than 5 years from now, like retirement or paying for her kids' education. Amala also learned that, unlike saving, investing has the element of risk. Since investing her money would mean more risk, she decided to wait until she had created an emergency fund and had money she wouldn't need in the immediate future to start investing. Now, with a healthy saving plan in place, you, too, can become an empowered financial decision maker like Amala.